Okay, couple last things about options. I know that last video, the options 5 was supposed to be the last in the series, but excuse me, after I closed it down, realized you need to know a couple things more. Do not buy options which are way out of the money. You'll see option prices at 0.02, 0.01. The probability of them ever getting in the money or moving towards the money and giving you a profit is kind of slim. I mean, the leverage on it is terrific if it happens, but most of the time you'll lose. The only time you use something like that is if you fear or if you believe there's going to be a serious change in the market up or down. I mean, major move. Then you set up what's called an Iwaki play. And an Iwaki play, pardon me, an Iwaki play is, and I'm going to show you what this means, or how it's spelled anyway, E-W-A-W-K-I. An Iwaki play, end of the world as we know it, is one where, as I say, you believe there's going to be a major move, either catastrophically down or tremendously up, in which case you could be a bit further out of the money, and the profit on this can be unbelievable. I mean, you know, we're talking in multiples of tens, you know, 30, 40, 50, 100 times what you put into it. Also, you put it there if you, for example, if you fear a market crash and you think your portfolio is going to get toasted, you could set up an Iwaki and come away more or less whole. And to be perfectly honest, I am looking these days myself at setting up an Iwaki play of my own. Anytime you want to get in touch with me, go to my website, and down towards the bottom is a place where you can reach me. Final point, don't get into option trades which are illiquid. And you can tell they're illiquid because typically there will be very few contracts listed. I mean, you can also compare the volume to other things. Here are the things that if you're starting out, the kinds of option contracts you want to get into. And I'm just going to list a few here for you. Let me pause this for a moment. Okay, not all stocks are optionable. When you go there, you look to see if it has options, and it may or may not. These are the ones most commonly traded. The SPY, which is part of the SPDR series, which is related to and reflects, presumably, the action of the S&P 500. It's called an ETF, the SPY is. Pardon me. As are the Qs and the diamonds. The Qs represent the NASDAQ, and the diamonds represent the Dow. So you've got S&P 500, NASDAQ, and Dow. Or any heavily traded stock you can also trade. By the way, an ETF means exchange traded fund, and that's what these are. They're not really stocks, they're baskets of stocks. They're an index representing a basket of stocks. So that's where you'll find your liquidity and your volumes. That's where I recommend you start out. Final pointer, I'm not recommending this for you. You know, do as I say, not as I do. But sometimes I'll jump into an option contract and begin losing money immediately. But if I feel strongly that that contract is going to move in my direction, I will average down. But they're the same hazards or even worse hazards as when you average down in a stock. So be careful of that, but that's a possible strategy as well. And for my tools, finally, I keep saying finally, my tools come from the FLIR 2 ebook, H205, synthetic trend lines, Tau and IOTA, FLIR and FLIR 2, and some other tricks of the trade. You want to get a copy of it today. Alrighty, good day to you.